Using covered calls in your portfolio could be a great opportunity to generate more income. We'll be going through what a covered call is. We'll be discussing the pros and also the cons, and we'll go through an example live in the flesh to give you an indication of what we are talking about. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, ask if you learn something new or you get some value out of the video. Hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. I know when it comes to options, a lot of people get scared. They're afraid of the risk that's encompassed. But obviously, the more that you know about this subject, it will give you a little bit of familiarity of what is going on in the background. And that's my goal today, is to give you a high level view of what's going on so that you can start looking and exploring to see if this is a potential opportunity for you. So let's start off by discussing what a covered call is. So a covered call is when you already own shares and you're going to put an option out in the market for somebody else to buy those shares. Now, there's a few benefits which we'll discuss later, but it's important to note that this can only be done in lots of 100. So you must own 100 shares before you start getting into covered calls. So basically, the covered part comes from the fact that you already are in possession of those shares. So when you're selling an option to somebody else, it's the right for them to purchase your stock later at a specified price. And this is known as the strike price. So hypothetically, if you bought shares at 90 and you'd be okay of giving them away or selling them at 100, you would go in and you would write a covered call option at 100, which means that you would be banking that profit from the 90 to 100, that $10 per share profit in your pocket. But also you would be collecting a premium. So you'd be collecting what is known as the option premium. So we'll go through in the example, we'll give you an indication of what those numbers could look like a little bit later. And this is a very important strategy to use when the market or the particular stock is going sideways, because there is a risk if the stock does go to above 110 or 100 that you could be missing out on additional profit. So you have to be okay with that stock going up to that number and potentially removing from your portfolio. First of all, the premium or the pro is that you're collecting the premium. You're also collecting any dividends that come with it. And the cons is that sometimes when you're doing this with dividend stocks, the option premium is a little bit on the lower end, which we'll show you a little bit later. And also, the biggest con is that eventually, if it does hit that strike price, it could be called away. So if we're going through a bull market, this isn't the best strategy. But if we're going through a period where stocks are maybe falling off or staying the same, this could be a way to gain and garnish that additional income because you're collecting that premium. So with that being said, I think it's a perfect opportunity to go through and pull out an example of what's going on here. And I've decided to start in the Canadian marketplace. Options and aren't that frequent. So the opportunity isn't as large as if you were to hold American shares. The options market, obviously there's more people playing in that sandbox. But I thought we would go through an example on the Canadian side to give you an indication. So we're going to start off with Canadian Pacific Rail. I've created a spreadsheet here. If you're interested in it, let me know or send me an email. I could definitely send it to you. And we're going to be starting off by pretending, just for hypotheticals, the first portion of the chart here isn't really something that is accurate or needed in the long run. Just gives us an indication a little bit longer later in the video. So CP, let's pretend we own 100 shares because we know we need 100 to make up for one contract. One option contract is equivalent to 100 shares. We're going to say that we bought these shares at $89. We're also going to note that we paid $4.95 commission, and that's through Questrade. If you're interested in signing up through Questrade, free $50 in trades if you use my link below. So go check that out. We have our average cost basis. It's obviously $89 per share times the number of shares that we own, which is 100, and then factoring in the commission that we paid for it. CP also pays a dividend. It pays 76 cents per share. That is annually. So our annual dividend after this year end of holding it should be $76. So now we're going to take a look at the covered call option. I'll show right now the April expiration. It could look intensive. There's a lot of numbers on this chart here, and we're kind of trying to figure out what is really going on. So this is the April 14th expiry, meaning that you're writing an option for somebody else to buy your shares if it's at that desired strike price. And the strike price are denoted in this gray right down the middle. So we know that we bought it for $89 a share. So we're not going to write it for anything less than that. But we also know today in the market, it is trading for $98.91. So it would be silly for us to write it for anything below 98. So we're going to start taking a look at the 100, 105, or 110. So when we're looking at the 105 here, we're looking at what the option premium is. So we can take a look at the far left column that says last. And in that last column, we can see that for the 105 strike price, the option premium last traded at $1.60. Now that $1.60 is to be multiplied by the number of shares. So that's $160 of option premium you would receive. So taking this information back to the chart here, we have our current price of $98.91. We are figuring that we're going to give somebody else the option to buy at $105 a share, which is about a 6% upside from what the price is today. And the option premium is $1.60. So the commission in Questrade to do an option trade is $10.95. So I factored that into the equation, and the premium received is $149. So taking this into account, if I am to write this covered call option, I'm going to get almost double what I would get in a dividend yield for the year in just a quick turnaround time from today to April the 14th. I'm going to receive $149. Now, that being considered, if the shares are 105 when April 14th rolls around, I am at risk for somebody else exercising that option or exercising that contract to say, okay, I've met my obligation of my strike price of 105. I now want the 100 shares. So you'll be obligated to sell if it's above that. So that is the risk. The risk is that CP happens to have great earnings, and all of a sudden, the stock shoots up to 106 or 107, and those shares, you're going to have to sell them to fulfill your side of the contract. So I put a little bit of a risk calculator in here, giving you an indication of what's going on. Called away. So that's basically if it sells at 105, I'm going to receive 10,500 because obviously 100 shares at $105 dollars per share. I'm also collecting that premium in the interim. So that's the $149. But if this number hypothetically, when we're looking at it long term, if the shares are at 106 and 38 cents, basically it would have been better off for you to just continue to own the shares. So that's the what if price that I've calculated here. But it's also important to note that if the shares are under 105, if they stay at that $98 level, you can let this expire worthless. You won't have to pay any additional commission on the back end. Questrade will close that position out for you, and you'll be able to basically receive that $149 in extra premium and extra income. So if you have a stock out there that is kind of trading sideways and the range that it trades at, it doesn't get above a certain amount, and it doesn't go below a certain amount, you can look at deploying the strategy especially in a time like today when we're going through a little bit of a sideways market. So I just wanted to throw this on your radar. Let me know what you think. If you're interested in the calculator, let me know. Send me an email, write me a message down below with your email. I can definitely send you a copy. I hope you enjoyed the video. If you're still here with me, hit that like button. I definitely appreciate that. And also hit that subscribe button. Hope you all have a great week in the markets. Happy trading.